In just the last week, Super Microcomputer has seen a crazy amount of volatility as they announced on Monday that they would be offering $2 billion of convertible debt. This announcement sent the stock down by almost 10% in a single trading day. And that's because this type of debt can have a negative effect on existing shareholders. The name convertible notes comes from the fact that this debt can actually be converted into shares. And what this ultimately does is it dilutes existing shareholders. It means that the same amount of EPS is now being spread over more shares. And if you're new to this channel or even new to the market, one thing you need to understand is that stock returns are directly proportional to the amount of earnings that a company brings in per share. And you can basically prove this point by looking at Super Microcomputer and how it traded throughout the day on Monday. At one point, the stock was down by around 10%. However, after hours, it traded up slightly and ended with a loss of only around 7.25% on the day. So if you look at Super Microcomputer's market cap, it is sitting at $27.82 billion. If the company is offering $2 billion worth of debt, or basically $2 billion worth of shares, that is around a 7.2% dilution rate, which again, Super Microcomputer on the day went down by around 7.2%. So again, this relationship between earnings and stock returns is extremely important to understand. And when you understand that, you can capitalize on it. If you were trading throughout the day, right, the stock moved down by 10%, it was oversold at that point, and then investors came in, realized that, and ended up buying up the stock. However, why did Super Microcomputer over the next day and a half move up by around 10.5%? And that's because a lot more details around this debt actually was released by Super Microcomputer. They released a statement saying that the debt was being offered at a price of around $55.20 per share, which at the time was a 35% premium compared to the stock price of $40.89, or around a 20% premium from the current stock price of around $46. This is obviously very encouraging for investors because if other investors are willing to come in and buy this debt that is offered at a share premium of $55, that means that right now they must believe that the stock is somewhat undervalued. Another positive that was announced was that Super Microcomputer plans to set aside $200 million of this $2 billion in debt for repurchasing of their own shares. This will help reduce some of the dilution. The other thing that Super Microcomputer plans to do is they're planning to set aside around $158 million on capped call transactions. Basically, this allows Super Microcomputer to buy back some of the debt before it would be converted into shares. And the rest of the money is planned to go to growth and business expansion. That is obviously going to be huge because if they are able to expand their business, likely what that means is expanding EPS numbers as well. Super Microcomputer didn't have the greatest earnings announcement during the last quarter. However, one crucial comment that the CEO made was that some customers delayed making platform decisions in this quarter. What that likely means is that they are now making those decisions during this current quarter. And that is why Super Microcomputer needs this additional capital to fund some of that additional growth. So you have less dilution than investors originally thought, and you also have the potential growth that Super Microcomputer is facing, and that is the reason why they need this additional debt, and that's likely why the stock rebounded around 10.5% over the next day and a half. However, where does that leave Super Microcomputer stock, and where could it be headed in the near future? Right now, the forward P ratio on this company is sitting at a 13.93. That is incredibly low, but it is up slightly from where it was at in December of around a 9 forward PE ratio. And for some low growth companies, companies, a 9 or even a 13 PE ratio is a fair valuation. However, for Super Microcomputer, they're expected to grow by around 48% in 2025. They only have one quarter left in their 2025 earnings, and in 2026, they are still expected to grow by around 34% for their top line numbers, bringing their top line revenue to almost $30 billion. Most companies that are growing their top line by 30+% are going to be trading at a PE ratio that's at least a 25 to maybe even a 35. However, Super Microcomputer has a problem, and it is with their bottom line numbers. Their bottom line EPS came in at $2.21 in 2024. However, for 2025, again, there's only one quarter left. They are expected to come through with only $2.08 of EPS. But analysts are expecting things to get back on track in 2026, with EPS coming in at $2.84 expected for the year. There's a high estimate, however, of $3.35 of EPS. But these are my projections for 2026. I think if Super Microcomputer underperforms, they'll put up around $2.25 of EPS. That would result in a forward P ratio of around a 20.72, and this would be earnings growth of around 2% compared to their 2024 numbers. I think at this point, the company could trade anywhere between a 10 and a 20 PE ratio, which would result in a stock price anywhere from $22 per share to $45 per share. So obviously this would be pretty disappointing for Super Microcomputer. I think the way that this happens is if the Fed doesn't raise interest rates and Super Microcomputer underwhelms in terms of their performance, and potentially we see a little bit of a pullback in the overall AI market. I give all of this happening around a 30% chance. What I think is a lot more likely is the Fed actually drops interest rates and we see a relatively stable AI market. I give that around a 50% chance, and that is my inline number, which is around $2.84. Again, in line with analyst expectations. That's almost 30% growth in terms of their earnings. I think at that point, Super Microcomputer could easily trade at a 15 forward P ratio, more likely would trade anywhere from a 20 to a 25 forward P ratio, which would result in a share price anywhere from $42 per share to $71 per share. And then finally, I have my outperform numbers sitting at $3.25 of EPS. I give this around a 20% chance of happening. This would again be the Fed lowering interest rates. I think that the AI market would have to be very strong. And then I also think that Super Microcomputer would have to stay as a very strong player in the server market and really capitalize on their position. This would be almost 50% growth in terms of their earnings. And I think at this point, they would easily trade at a 25 to a 35 PE ratio, which would result in a share price anywhere from $81 per share all the way up to $114 per share. But full disclosure, I do own shares of Super Microcomputer. This is the YouTube portfolio, and it is sitting at an all-time high of around $67,000. And within this portfolio, our second largest position is Super Microcomputer. We have 240 shares. They were up 9% today to almost a 50% gain on this position overall. Our first largest position is Google. We have 77 shares, up around 10%. And AMD is our third largest position now. We are up almost 77% on it. Other than that, we have Microsoft, Adobe, SoFi, PayPal, Abercrombie & Finch, Alibaba, United Health Group. We have Palantir, United States Lime and Mineral, Estee Lauder, Apple, and Hawkins. But I always say, don't buy a company just because some random guy on YouTube did. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. Let me know in the comment section your thoughts on Super Microcomputer. Is this a company that you hold? Is it one you are looking at buying? Where do you think the price is headed over the next year? Thank you guys so much for watching. I hope you enjoyed the video. And if you did, make sure to drop a like down below and subscribe for more videos like this one. And as always, have a wonderful rest of your day.